So Indian market is holding its ground despite the volatility that's rocking global market. However, Nifty is seeing major resistance at the level of 18K mark with only 3 months left to end this year. Will Dalal Street break the crucial resistance and march ahead? Let's find out how the Indian market is placed versus peers, which will help you formulate a right investing strategy and discuss to this in detail. We are now joined by Mihir Vora, Chief Investment Officer at Max Life Insurance Company. Good evening, Mihir, and welcome to the ET Money Show. Now here, let's start with talking about Europe and China. Tell me, how stressed are you with the Eurozone doing rounds of being in an almost recession scenario? How do you look at it?
Hi, Kavita. Always a pleasure to be on your show. Europe, I think, is going through hell, and I don't see a very easy solution to this because Russian gas and Russian oil is not going to be easy to be replaced. So there might be a serious blow to Europe's manufacturing capacities, and that's not going to come back in a hurry. So, I think it's a given. It's almost a surety that Europe is going into a recession. And as we speak, as we go into the winter months of November, December, January, things on the heating front are only going to get worse. So I think things are not looking good in Europe per se. The only flip side is that because of Europe's issues on manufacturing, they have been shutting down many plants which are energy intensive. So some of the capacities like in steel, aluminum, glass, chemicals, even a lot of manufacturing of automobiles also is actually getting curtailed. And to that extent, we are seeing companies in India actually benefiting. And there is a good amount of order book, which was not expected, say, 6 months ago, coming from the European situation. So that's something that one needs to keep in mind. On China, I think China will come back on its own. I don't think in the short term it's going to make much of a difference. It's just a question of when they open up their lockdowns in some of the major cities. Of course, they do have some issues of energy because of flooding in certain places and drought in certain places, but those will be shorter lived. But I think the bigger call of multinationals moving to India as a China plus one strategy, I think that's panning out quite well. And we do see a lot of companies coming in and, setting up capacities, aided, of course, by the government's incentives on PLI, which is the production incentive schemes, etc. So I'm quite bullish on the China plus one thing panning out, and things are happening on the ground as we speak.
Got it. I think I'll be having more questions on the China part, but then Fed and ECB have been very hawkish, which is the need of the hour, of course. But then till how long do you think the hawkish tone is likely to sustain? Because even though it looks like a developed economy's problem, but a longer duration hawkish tone won't be that good for India. What do you think?
Of course, the US and ECB being hawkish cannot be good for any asset class, whether it's stocks or bonds or real estate or commodities. Because what are they trying to say? They are trying to say that because consumption is so strong, because the economy is so strong, because unemployment is so low, there are pricing pressures in the economy. There are upward pressures in the economy. So ultimately, there is no other way except to slow down consumption, and that's what they're trying to do by hiking interest rates. And when you slow down consumption, you of course see GDP slow down, and that's typically not good for any asset class, including India. What also happens is once they hike rates, because bond yields have moved up, the asset allocation also changes, because if equities don't go down, then the bond portfolio, which has gone down by almost 15-20%, becomes underweight in the overall asset allocation. So they have to buy bonds and sell equities to rebalance. So that's also something that we have seen. If you see the Dow Jones in the US, that's down almost 20% from the peak, and bond prices also down. So you may not see money coming into equities in a hurry because of asset allocation. So you're right. It's not a very good situation where two of the largest central banks are hiking. India has so far managed to stay isolated because of a couple of reasons. One is, of course, our economic recovery is just beginning, unlike in the West, where they had stimulated so much during the lockdown that now they have to undo it because they created inflation because of their stimulus. We never stimulated that much, so our natural cyclical recovery is coming up. So to that extent, there is a lot of pent-up demand in services and goods in India, which we are seeing across the board. And the second thing is that, because of our growth, we managed to now get back FII flows. So while In the first half of the year, we saw good amount of FII selling, and that was, as we discussed, because of asset allocation. In the last couple of months, in the last 1 month especially, we have started money coming in on its own because of India's inherent growth rate. But but if the ECB and Federal Reserve continue to tighten, then we cannot sustain this. There will be a correction in the Indian markets too.
Right. Now, let's analyze the China situation also over here, Mihir, because tell me one thing, how is China looking to you in terms of market crisis, the struggle that we are seeing in that sector? There are definitely slowdown in growth. GDP forecasts are being cut over here. How do you see all of this impacting India?
Sure. So China is going through certain structural and certain cyclical issues. Structurally, I think they have created so much capacity that it's kind of underutilized. Real estate, I think there's a bubble and which we are seeing correcting, and I don't know how they are going to solve it in a short period of time. So real estate is one of the biggest segments for the Chinese economy, and that's going through hell. So that's one of the big drags on the economy, not only on the economy growth, but also on the banking system and the government borrowings issues. So real estate and general slowdown. Second is China is also facing, has already peaked out in terms of its demographics. So the working age population in China is likely to keep on decreasing because of the one-child policy that they adopted many years ago. So that's another structural issue with that. And on a more tactical level, I think President Xi is likely to get renominated in November. So there's a election or so-called election where they will select the new leader, but it's almost certain. But before that, there's a lot of build-up and changes in the government at the lower levels, etc. And they don't want to upset the apple cart too much before that. So no major policy announcement, no major stimulus has been announced before this in the months preceding to this. So till November, there may not be major announcement from China. And second is, again, because of this meeting coming up, the re-election of President Xi coming up, they also want to ensure that there is no issue on COVID. So they've been really, really strict on the COVID. They almost are adopting a zero COVID policy. And because of that, at the first mention of the first case of any COVID in any major city, they have been going for lockdowns for the last couple of years. Even as we speak, there are lots of large cities under lockdown. So that's created a lot of disruption in the Chinese economy. But that's more on the shorter term. In the longer term, I think what people have realized in the last 2 years, especially in the last 2 years because of COVID, and now with the tensions that China is facing with the US in terms of trade and the Taiwan issue, etc., people are definitely wanting to de-risk away from completely depending on Chinese manufacturing. So that, I think, is a huge positive for India. And as we discussed, a lot of PLI schemes have been announced by our government at the same time, which is attracting a lot of domestic and foreign capital. So that's a long-term good for us.
Sure. So that was all about China that you explained us in detail, Mihir. But then let's talk about FIIs and DIIs. So since last few sessions, FIIs have actually taken their interest off India. But then let's talk about DIIs. Where have they gone? Because there were rounds of them supporting the market run earlier this year. But then do you analyze a strong return of DII given the festive season around?
So I think there is ammunition available with DIIs, and anyway, your 10,000 crores of SIP flows are there. So to that extent, there is stability. There is stability in mutual fund flows. There is stability in insurance premium collections. So I don't think there's an issue with DIIs. They've been holding up the market for like a year now against FII selling, and these structural changes don't change that fast. So I'm not too worried about DIIs flows turning negative structurally, at least in the short term. So I'm not too worried about that. And not only DII flows, if you look at the number of brokerage accounts being opened, number of demat accounts being opened, there is good retail, traction in the capital markets. So as of now, I'm not too worried. But yes, if we see SIP flows getting discontinued or massive redemptions on a lump sum basis from DII, then I would be worried. But as of now, that's not the case.
Mihir, I also remember reading somewhere that you think that India's growth outlook actually looks better than pre-pandemic now. Tell me one thing, what's the rationale behind this? Because I remember you quoting this somewhere.
So a couple of things. One is that during the pandemic, we did not stimulate hardly 1 or 2% of GDP, whereas the West did 10% of GDP 20% of GDP. It was like a bazooka. It was like a nuclear option that they used to make sure that they flood the market with demand and liquidity. So the kind of stimulus that the US did, that the Europeans did, Japan did, was amazing. Now that we are coming back into a normal zone, our base is itself so low that it's carrying us through. So to that extent, I think we have wings because we never overstimulated, so there is no reason for us to cut back. And there is the inherent demand of the Indian consumer. It will ensure that we see 6 to 8% growth in the next couple of years. So that is one portion. And the second is the big structural thing that we discussed about China plus one, even Europe manufacturing shutting down because of the gas issues, energy supply issues, and that production moving to other parts, including India, that demand coming to India. And the third is that the government at the same time has done a lot in terms of the PLI production link incentive scheme rollouts across sectors: electronics, textiles, chemicals, pharmaceuticals, defense manufacturing. So I think a lot of these things are coming through, and we are also seeing a cyclical recovery in real estate. So to that extent, I think relatively speaking, we have ammunition, we have inherent pent-up demand, which should ensure that at least for the next couple of years, our growth should look better than the rest of the world.
All right. So now, since India is domestically on strong grounds, what local or domestic sectors are you looking at?
Broadly, the big theme is local versus global. So domestic demand areas, domestic manufacturing, domestic consumption is preferred over global sectors like say commodities, energy, like IT services. So we are underweight on those segments and preferring more on the local segments. And second is this whole manufacturing in India, including the defense manufacturing. So that's another that we are playing. Again, a local theme, but will benefit the local economy. So these are some of the broad calls that we've taken.
All right. But then in the end, now since we have to sum up this conversation, Mihir, one word of caution to our investors.
So while there are tailwinds on the domestic front, there are headwinds on the global front. As we discussed, the ECB and the Federal Reserve in the short term are very hawkish. That's going to kill demand, and we will see the global economy slowing down even more in the coming months because of non-availability of gas, and inflation continues to remain high in US. And the Federal Reserve has now realized that it probably may go out of control if they don't sound very hawkish. So they're going to sound hawkish for a while. So and that's not good for liquidity flows. So you might see FII flows continue to be negative for some time, while domestic flows are positive. That does create a headwind. So I think the local situation is good, but you can't have a situation where Europe and the US Fed are hiking rates by 50 basis points, 100 basis points, and India can't do anything, because then it leads to currency issues. So we will also see a rise in interest rates in the next few months. We will also see liquidity crunch locally as well as from the global flows. So to that extent, that's typically not good. That will create volatility in the market.
All right. So that will be all, Mihir. Thank you so much for helping us read between the lines of this market movement right now.
Thank you. Always a pleasure.